I've been reaching out to all of our subscribers asking what is it that you really want to hear about, and overwhelming majority wanted to hear about cryptocurrency. So today's Wealth Talk, we're going to talk about cryptocurrency. So get ready. Cryptocurrency, guys. Today, the news hit a couple big things. Mastercard is going to start accepting Bitcoin. Also, the world's oldest, well, let me back up. The U.S. oldest bank, Bank of New York, is also going to start taking cryptocurrency. We heard just a few days ago that Tesla is going to start allowing transactions in cryptocurrency. So where we're really starting to get now is this network effect that you're starting to see people pile on. Let's just think about it. If you're Visa, what are you going to say? We're not going to take cryptocurrency when Mastercard is. We saw just last year, and what really woke me up to cryptocurrency was when I logged into my PayPal account and it said trade cryptocurrency here. That was something when I realized it would also be allowing you to do transactions in crypto, where it was really becoming mainstream. And since that time, we've continued to see company after company pile onto this. And so I want to make this caveat. I, by no means, am a cryptocurrency expert. There's people that know more about cryptocurrencies, but I think what's important for me to talk about cryptocurrency, I'm going to be talking about cryptocurrency from a standpoint of a large asset management firm. You know, our firm collectively with our parent company manages almost $180 billion in assets. The portfolios that I manage on a daily basis are several hundred millions of dollars in assets. And when you look at the world in general, in terms of how they allocate their assets, meaning if you have $1 million, for example, how do you allocate that? 5% to this, 10% to this, so forth and so on. I'm really starting to think as asset allocators start to take a look at what's going on with cryptocurrencies, what they normally used to go to as a hedge for currencies, inflation, the printing of money, and so forth, being gold. I'm starting to see asset allocators now move towards cryptocurrencies. Now, when you talk about cryptocurrencies, it really comes down to two, right? We've got Bitcoin, which is about $891 billion in market cap. I've got Ethereum here at about $204 billion in market cap. When you put those two together, that represents over 80% of the total crypto market. So when you're talking about cryptocurrencies, you're first of all, obviously the juggernaut is Bitcoin. You're talking about Bitcoin, secondarily Ethereum. Now, there's a lot of small currencies that come under that, but we're going to kind of really stick today to Bitcoin to give you guys an idea of what we're looking at. So I said the valuation of Bitcoin is about $840 billion, the market cap. So if you took all the Bitcoin out there, times it by today's price, we closed at about 48,484. That's what gets you up to that under $900 billion number. So to put that in perspective, if you look at Apple, if you look at Google, if you look at Microsoft, if you look at Amazon now, all of those companies individually are over $1 trillion. So if you took all the cryptocurrency in the world right now in terms of Bitcoin, you would not be able to buy one of those companies outright. So when you put it in that perspective, it's still a relatively small market. So there could be some room to go. Now, the toughest thing by far, and no one's going to be able to give you an absolute way to value Bitcoin, let's say, for example, is how do we put a number on that? What is it worth today? And, you know, it's kind of like gold, right? There's no necessarily intrinsic value of gold. Gold doesn't pay a dividend. You can't use a valuation multiple on it. There's ways that we go around it, but it's very, very difficult to be able to quantify it. And as I said, I think a lot of asset allocators, big money, pensions, endowments, wealth management firms, RIAs like us, are probably going to be looking at it more as a store of wealth, as a replacement, because Bitcoin is not necessarily going to be used as a currency. There's a lot of other cryptos on there that are much more suitable to be used as a currency in electronic transactions. It's going to be more a store of wealth. And so when you look at the gold market's about $13 trillion. So a lot of people say today, based off of the price of the gold market, how much Bitcoin is outstanding, if you were to put a value on it, taking just 10% of the gold market. So let's just say, for example, in a lot of portfolios, you see people with a 5% allocation to gold, just kind of a standard allocation. If they decided, hey, we're going to take 10% of that and put that over to Bitcoin along with gold, and if everyone did that with all the currency out there, that would get you to a price on Bitcoin of about $62,000. So definitely some upside. Obviously, I've heard a lot of numbers in the 120, 130 range. And again, we're trading at about 48,000. What they're thinking there potentially is that you'd see about a 20% dispersion from gold into Bitcoin as the store of wealth. Very difficult to say, obviously. And then you could take the numbers, so forth and so on, to where if you would at today's price took 100%, which I don't plan to happen, of gold from asset allocators, that gets you up to over $600,000. Now, there's a lot more that can move it, and there's a finite amount of Bitcoin out there. There's a lot of things that are very interesting, though. You're starting to see, I talked about this network effect where there's some validation by Tesla, by Visa, well, not Visa yet, but Mastercard, by PayPal, by the Bank of New York, who are starting to really validate this as a currency, validate it in terms of an asset. And so in doing that, a lot of people are starting to pay attention. So in the investment advisory world, there's a designation called the Chartered Financial Analyst. It's kind of the pinnacle in terms of asset management. We have two CFAs, Chartered Financial Analysts, that are internal here on our investment committee. And as I said, that's kind of the pinnacle. Now, what we've seen recently is the CFA Society is now starting to offer programs on cryptocurrencies in general. Reason being is, with this adoption, they want to make sure that they're at the forefront, that they're putting out valid education, that they're able to inform and educate CFA charter holders to make sure that they're making good decisions. And so when I started looking at that, and we have one of our CFAs that's enrolling now, I really started looking at what was some of the thought process behind that. Now, when you allocate your assets, one of the most traditional asset allocations that you hear is a 60-40 mix, with 60% in global stocks and 40% in bonds. And so today I got something from the CFA Society where they show, if you were that kind of asset allocator, if you were to take, and they did it from 0% to 10%, meaning out of that 100% allocation, if you allocated between 0 and 10% to a cryptocurrency, what would that have done for your portfolio? So they took a time frame. It's a pretty short time frame. For those of you who are data statistic hounds, it's from January 1 of 14 till September of 2020. Remember, Bitcoin's a very new asset, but they showed just that traditional 60-40 mix with 0% to Bitcoin, you return 20.6%. As you went to a 5% allocation, so 95% to that traditional 60-40, 5% to Bitcoin, that rate of return went from 20% annualized to 48.73%. So that return more than doubled. Now, obviously, the volatility of the portfolio went up, but there's something called a Sharpe ratio. We won't get into that today, but that's a measurement of per level of risk if you're being rewarded. And the higher the Sharpe ratio, the better. And because that Sharpe ratio also went up, that means you're being compensated for the risk. And so the idea now is asset allocators, if you were to actually take a percentage of your portfolio and allocate that to Bitcoin, it's actually giving you a more efficient portfolio. It's giving you a portfolio with absolute higher rates of return. So this is the type of data. And guys, I see this time and time again. My industry in wealth management is very slow to adopt anything new. And quite honestly, that's not without reason. Let's remember, the institutions dealing with trillions and trillions of dollars, financial institutions, a lot of people like us, we deal with our clients' entire savings. And so we're never going to make any decisions, nor is any reputable financial institution going to make any decisions simply based off of a very momentary piece of data. Everybody wants to get as much information as possible. So that way, when we talk to our clients, we can tell them both about the opportunities in investing in Bitcoin and cryptocurrencies, but most importantly, the risk and what to look out for. And so when you talk about this 5% number, I would caution people that get over 5%. When you do modeling in portfolios, there's something called idiosyncratic risk, meaning all that means is when you get too high of an allocation to one thing, and usually we like to say over 5%, the predictability of that portfolio, especially for people who are using, hopefully all of us, their portfolios to meet obligations, retirement, college savings, subsidy in their income, when any of those things are, you want the highest amount of predictability possible. So in allocating to cryptocurrency, if you're going to do that, you want to kind of at least right now keep it to that 5% range to be able to manage it. Okay. So again, we're now seeing the CFA charter holders really starting to look at this. We're seeing big institutions look at this. And what is the narrative? I'm a big believer. One of the portfolios I manage called the Adaptive Alpha portfolio. Our investment thesis when we buy a stock, this is a concentrated stock portfolio, it has to have a thesis around it. So, for example, it's an active portfolio at the beginning of 2020 when we saw the pandemic hit. What we decided was, hey, our thesis is people are going to be locked at home, remote workforce, travel is going to be shut down. And what we wanted was companies that were really around that narrative. So we looked at some of the stay-at-home stocks like Zoom and CrowdStrike, and those that you guys know I've talked about. Well, the thesis and narrative today more than ever is extremely attractive for cryptocurrencies. Why? Because central banks around the world are continuing to print money. They're printing and printing and printing, and everybody's starting to get worried about this from two standpoints. Number one, of inflation, where you have too much money chasing too few goods or services, and you start to see things skyrocket in terms of price, but also in terms of the value of the dollar. As you print more and more and more, the value of the dollar goes down. So for people who are sitting in dollars, those are depreciating. And what you've seen is because there's this finite amount of Bitcoin, and as more and more people begin to believe in it, which sometimes is all you need, the valuation of Bitcoin, while the dollar is going down, is actually going up. So people are saying now, for my reserves, maybe it makes sense to use a part of that portfolio or a part of my cash allocation into Bitcoin. Now, the question is, are there going to be further catalysts outside of money printing going forward that could drive up the price of Bitcoin? Well, one of the things I'm looking at, again, when you look at financial institutions, something obviously why I really wanted to have this conversation is to give you a perspective from where the money is and where the money is going to be going. Now, Bitcoin as of right now is not a security. So the SEC is not allowing ETFs of Bitcoin, kind of like we saw long time ago with gold. You were never able to buy gold in an ETF, but then came GLD. And when you saw that, we saw the price go up because there was a lot more investors chasing that. My thought is it's just a matter of time before you see the SEC come in and regulate that, especially when you're starting to see credible institutions like the CFA Society come out and start to put some parameters and education around this. I think it's a matter of time before that happens. I think it's a matter of time before you see a cryptocurrency ETF. That will usher in a new wave of buyers. I think that could be a catalyst for price to go up. Now, at the end of the day, I think we're going to see continued volatility in the price of Bitcoin, Ethereum, and all these other ones. That's going to be forgiven. Now, the question is, though, in terms of that volatility, what do you do? Well, I think, in my view, is it's very hard to speculate with Bitcoin what's going to happen. If you fundamentally believe that fiat currencies like the dollar are going, the euro and so forth, are going to be under pressure, and that's a long-term bet, it's probably best to look at it as part of an overall investment portfolio. It's probably best to look at this as a long-term time horizon, which means just like any stock or any other asset class, real estate, that you buy at a long-term time horizon, you're never going to really pick the top, you're never going to pick the bottom. So maybe a strategy, if you're going to go out and buy it, you've decided anyway, you talk to your financial advisor that it's right for you, you might want a dollar cost average into it. And dollar cost averaging simply means, let's say you have a $10,000 portfolio. And if you're going to put 5% of that portfolio into Bitcoin or $500, maybe you do that over a 5-month period where each month you buy $100 at a time, because the price is going to go up like this, up and down like that. So you're going to be buying some at the high, yes, but you're going to be buying some at the low, kind of like your 401k. For those of you who are working, putting money in all the time, yes, you're buying some highs, but when those dips come, you're buying some at a low, and you get an average cost of those. So that's probably one way to do it. But I think, at the end of the day, a lot of financial institutions, a lot of financial advisors have really been dismissing the idea of cryptocurrency. I don't think that's very smart to do anymore. I think you should start looking at it. I think you should start doing some research, because I think the fundamental thesis and the network effect that's starting to build around Bitcoin, Ethereum, some other cryptocurrencies is really just getting started. Again, doesn't mean it's going to go up over time, but I think you need to take notice. I think you need to decide what you're going to do. If you're working with a financial advisor, ask them what their strategy is, what they're doing to educate themselves on it. And I'll tell you, if it's someone who's telling you, well, there's no future to that, don't worry, it's gambling and speculating, I'd question that advice. Because when you see large institutions, when you see the pinnacle of financial designations starting to educate their advisors on it, I think it's time for everyone to take notice. So from the perspective of someone who has to make decisions on real money for real clients, I'm here to tell you it's probably time to take notice. It's probably time to start thinking about an allocation to it. And also, like what we're doing, looking at companies out there that are benefiting from it. Not a recommendation to buy, but when you look at a company like PayPal, they're one of the dominant companies now actually doing the transactions for buying and selling cryptocurrency, will allow you to trade through it. So these trading profits for a company like that are going to be brand new. That's something that was never part of their balance sheet. So start looking at some of those companies. If you're not ready to jump right into Bitcoin right away until you've done some more research, maybe another way to play that would be able to look at some of these ancillary plays of companies that you can get comfortable with. So that's my 2 cents on Bitcoin today. I hope that gave you some insight about what our view is, some different ways to look at it, some validity of why people are starting to use it. Now, one thing I want to ask you guys, just like I got the topic for this week, if there's anything you'd like me to talk about, please drop me a line below. And if you haven't subscribed, please click the bell below, subscribe to the channel. We usually post every Friday a brand new topic just like this. My goal is to provide good, valuable information that's unbiased. I'm not getting paid for, to allow you to kind of cut from the noise of people who have, vested interest in things, to give you some good quality information, food for thought, to help make better financial decisions and ultimately achieve better financial outcomes for you and your family. So until next week, I'm Rob Luna, wishing you the best of health and wealth. Thanks for listening to this week's Wealth Talk.